All right. S&P 500 futures, strictly flat, just glued to 5,940. Nasdaq 100 is fighting for air, maybe up 0.1%. Dow's off about 15 points. But the volume is dangerously thin. Sentiment isn't just neutral, it's paralyzed. Bulls look exhausted.
Yeah.
And the bears, they're just waiting.
We are in a state of absolute macro-suspense. You can feel it on the desk this morning. It is thick.
That's the word, suspense. But let's be specific. This isn't just quiet, it's a standoff.
It's a standoff because the market has, it's lost its compass. We are staring down the barrel of tomorrow's January CPI print.
The inflation data everyone is terrified of.
Exactly. And because of those government shutdown delays, we're also waiting on the rescheduled non-farm payrolls for Wednesday. So we're operating in a complete data vacuum.
And if there's one thing markets hate more than bad news, it's a vacuum. Algos can't price unknown.
Right. And when the algos can't price the future, they de-risk the present. Look, the danger zone right now, it's the bond market. This is where the real story is. We are seeing deleveraging happening in real time. The 10-year Treasury yield is sitting at 4.23%.
Let's pause there. For the listener who just watches their tech portfolio, why should they care that the 10-year is at 4.23?
Because 4.25% is the critical resistance level. Think of the 10-year yield as the gravity of the stock market. As yields go up, the value of future earnings goes down.
It's just discounted cash flow.
It's basic DCF. If we breach 4.25, the gravitational pull gets stronger. The calculus changes for every single high-growth stock in your portfolio. Suddenly, that future cash flow is worth a lot less today.
So if that yield breaks higher, the cost of holding a risky stock like, say, Nvidia goes up.
Precisely. And that explains what we're seeing on the institutional desks. The smart money isn't making bold bets. They're moving from growth into what we call quality cash before the Fed quiet period. This isn't about alpha. It's about survival.
Okay, let's unpack the specific movers. We have a few names gapping pre-market that really tell the story of this fractured market. First up, Nvidia. NVDA is trading up 1.8%.
And let's be clear. Nvidia is the only structural pillar keeping the Nasdaq green this morning. Without it, we'd be red.
The rumor mill is spinning hard. We're seeing reports of a huge, $5 billion sovereign AI deal in the UAE.
That word sovereign is the key. You have to understand the shift. For the last 2 years, the AI rally was funded by enterprise spend, Microsoft, Meta, Google. Now we are talking about nation states.
It's a national security play, not just business.
Exactly. A country buying chips doesn't care about quarterly ROI. They care about strategic dominance. That $5 billion number validates the demand curve, but, and this is a huge but, it's a headline move. It's one stock against the world.
Right. Contrast that with Tesla.
Mm-hmm.
TSLA is trading down 2.4% pre-market.
This is the other side of the coin. The overnight data out of China is problematic. Deliveries missed the whisper number by 6%.
And let's define that. The whisper number is not the official analyst estimate, right?
Right. The official estimate is what the banks publish. The whisper number is what traders actually expect. It's the real bar. Missing that by 6% is a disaster when you're priced for perfection.
It just signals the demand isn't meeting the hype.
It tells us the Asian price war is accelerating. They're slashing prices to move metal, and that is going to squeeze margins. Investors are looking at that, doing the math, and realizing Tesla is trading like a tech company, but operating like a car company in a deflationary spiral.
Okay. Then there's Palantir. PLTR up 4.1%.
Classic defense play.
They secured a prime expansion contract with the Department of Defense. But looking at the charts, you've got a warning light flashing here.
I do. Momentum traders are piling in because government contract sounds safe. But the technicals, look at the RSI, the Relative Strength Index. It is screaming overbought.
So the RSI measures how fast the price is moving. Too high, the runner's out of breath.
Exactly. Palantir is sprinting uphill. This is a classic gap and trap. You chase the headline at the open, the algos see the overbought signal, and they sell right into your buying. You get caught holding the bag.
So Nvidia propping us up, Tesla dragging us down, Palantir looking frothy. Let's talk strategy.
You have to understand the context. We're in a liquidity trap. Technically, we're just stuck in a multi-month triangle pattern.
A triangle pattern usually means volatility is compressing. A spring being wound tighter.
And eventually it snaps. But right now, no clear trend. And in a liquidity trap, the first 90 minutes of the day are the kill zone. You do not chase fake-out moves.
The kill zone, I like that. So if we're not chasing, what are we doing?
Fading the extremes. The strategy is simple. Sell rips, buy dips. Don't expect a sustainable breakout until we get that CPI data.
Let's define the battlefield. I want to give our listeners the specific lines in the sand. Let's start with the S&P 500, the ES.
Lay it out.
The line in the sand is 6,930. Above that, bulls control the intraday tape. The bid is supportive. But if we slip below that, we're testing the 6,800 floor.
And 6,800 is vital. That's not just a number. It represents the whole soft landing narrative. Break that, and the market's saying the economy is weakening, but look overhead.
Resistance at 7,043, the all-time high.
And sellers are just camping out there. It's heavy overhead supply, a wall of sell orders. We are not punching through that today without a fresh catalyst. It's a brick wall.
And support to watch is 6,815.
The recent swing low, we have to hold it. If that breaks, the narrative breaks with it.
Okay, moving to the Nasdaq 100, the NQ. This feels heavier.
It is. It's lagging. The tech leadership is thinning out.
Line in the sand here is 25,100.
And this is crucial. If the Nasdaq fails to reclaim 25,100 early, that signals tech exhaustion. It means the leaders, the Mag 7, they're tired. They can't lift the index.
Resistance is sitting at 26,000.
We've rejected off 26K 3 times in 10 days. The market has a memory. Every time we get there, sellers step in. Until proven otherwise, that's the ceiling.
And support.
Down at 24,250 to 25,000. That's the value zone. Institutional buyers tend to step in there, but again, patience is the edge. Don't front run it.
Let's go deeper. We need to talk about the macro theses driving this exhaustion. We're calling this the Great Rotation, but there's a term floating around desks, AI Capex Fatigue.
This is the most important story in the market. If you take one thing away from this, let it be this. We are shifting from a market driven by hope to a market demanding a harvest.
That's a powerful distinction. Explain it.
For 2 years, the trade was hope. Hope that AI would change the world, hope for massive addressable markets. Investors paid any price for that future, but now we have a math problem. The tech giants are guiding for $650 billion in infrastructure spending in 2026.
$650 billion. That's
Yeah.
that's the GDP of Switzerland, a staggering amount of capital.
It's colossal, and investors are looking at that number and getting spooked. They're saying, okay, you're spending the GDP of a country on ships, where's the cash flow? They want immediate margin realization now, not 5 years from now.
So they're looking at this massive spend as a liability, not an asset.
Exactly. It's depreciation. If you buy a GPU, it loses value every day. It's overhead. And if revenue doesn't match it immediately, margins get crushed. That is AI Capex fatigue. The bill has arrived.
And the result is this violent internal rotation we're seeing.
It's a bifurcation. Money is fleeing the AI dream and moving into tangible earnings.
And where are they finding those earnings? Because pre-market, financials look like the strongest sector.
That's where the global money's going. Commercial banks. It sounds boring, but boring is profitable.
Why banks?
Resilient loan growth. We are seeing 15% plus year-over-year loan growth and record net interest margins. While tech deals with, fears of AI slowing down, the banks are just printing cash. It's reliable.
It's not just banks, it's materials too.
The materials supercycle. This is about industrial resilience. When you rotate out of digital assets, things you can't touch, you rotate into physical assets. Steel, copper, concrete, the stuff you need to actually build the data centers.
This leads us perfectly into our stock specifics. The prove it plays. Let's start with a name right in the eye of this CapEx storm, Amazon.
The dead cat bounce candidate.
Amazon cratered 8% on Friday. Fell off a cliff after announcing those spending plans.
It was a brutal reaction. The street was spooked by the cost of their AI build-out. Today is the day it has to prove that sell-off was overdone.
So the levels. Bull case is 182. It needs to fill that Friday gap and reclaim the 50-day moving average.
If it does that, it signals the spending fear was just an emotional overreaction, that buyers are defending the long-term thesis.
But the bear case, that's 175.
And that is the danger zone. If it fails to hold 175, it opens the door to the 200-day moving average. That would be a huge technical breakdown. It would mean investors are just de-risking anything AI-heavy.
Now for something completely different, the rotation to banks. But the global alpha leader today isn't a U.S. bank. It's the State Bank of India, SBIN.
This is fascinating. While U.S. tech is wobbling, this Indian bank is reporting its highest ever quarterly profit, up 24% year over year.
Massive relative volume, too. It's acting as the value proxy.
It's exactly what we talked about. High yield, tangible growth, banking assets in a high-growth economy. It's the anti-tech trade.
So for traders watching the ADRs, the bull case is a breakout above 1,150 rupees. which is about $70.
That would confirm institutional accumulation. It means the big boys, the sovereign wealth funds, they're parking cash there, hiding in India while the U.S. sorts out its inflation problem.
Bear case is profit taking at $1,100, so $67.
Which is natural. It's at a psychological high. A pullback would be healthy, but the breakout is the real signal.
Third name, Cleveland Cliffs,
C.
CLF.
The industrial play. Earnings this morning.
And we're seeing that materials supercycle tailwind. Tata Steel hit 52-week highs in Asia. The sector is hot.
And CLF is the domestic way to play that. It's all about automotive steel demand.
The bull case is 24.50.
That happens if they beat guidance and confirm auto demand is real. If they say, we're selling every ton of steel we can make, that stock flies.
Bear case, $19.
And the risk here is rising input costs, inflation. If they mention energy bottlenecks in the call, the algos will liquidate it. Margins matter more than revenue right now.
So, a diverse board, a tech giant trying to bounce, a foreign bank breaking out, and an industrial steel play on earnings.
It reflects the fractured nature of this market. There isn't one market. There are 3 or 4 different markets moving in different directions.
I want to pivot to what you call the pain trade, because there is a trap being set for the retail investor, and I want to make sure our listeners don't step in it.
This is the most dangerous part of the morning. Look at the macro overlay. We have 2 headwinds, the 10-year yield and the dollar index, the DXY.
Both are pushing higher.
Yields at 4.23. The dollar near range highs.
Why does the dollar matter?
Strong dollar hurts U.S. multinationals, makes their products more expensive abroad, but the yield is the real killer. Like we said, higher yields mean
Multiple compression.
exactly. Real-time multiple compression. Look at AMD. They beat earnings, did everything right, and the stock plunged 17%.
Because the AI magic premium is just evaporating.
The AI exceptionalism premium is gone. The market is saying, I don't care about your promise, show me the cash.
So what's the trap?
The trap is that retail investors are looking at these drops, AMD down 17, Amazon down 8, and they're conditioned to buy the dip. They think it's a sale. That strategy worked flawlessly for 2 years.
While the institutions are doing what?
Quietly rotating out. They are moving into under-owned value plays, small caps, energy, old economy. They are selling the tech rallies to retail.
So retail is buying the falling knife in tech, while smart money is buying the recovery everywhere else.
Correct. Big tech is actually the worst performing sector year-to-date, down 4%. Yet retail sentiment is still crowded there. That's the blind spot.
And if that 10-year yield spikes,
If we see the 10-year spike toward 4.35%, the Nasdaq becomes a dead money trap. You'll be stuck in a trade that goes nowhere or bleeds slowly while the Dow and small caps catch the bid.
that's a sobering reality check. It's not just about picking the right stock, but the right asset class.
The pain isn't just losing money, it's the opportunity cost. Watching banks and industrials rally 20% while you're sitting in tech hoping to get back to break even. Don't let your stubbornness on AI cost you the year.
But bringing it all together for the open. Final directives.
Watch the 10-year yield. It is the dashboard light for the whole session. Ignore headlines, watch the bond market.
If it stays stable.
That rotation into banks and metals, the value trade, it will accelerate. You want to be long financials, long industrials, follow the money.
And if it spikes,
If it spikes above 4.25 significantly, the whole board goes red. Tech leads down, but everything gets hit. That's a risk-off signal.
stay nimble. Keep size small.
Positioning over conviction. We're flying partially blind until CPI and NFP come out. Don't be a hero today. Preserve your capital.
The bill is coming.
Then positioned.